which components are included in the financial account of the balance of payment? The balancing item, foreign direct investment, the interest, profit, and dividends. Right. Walaikum assalam, Irbab. How are you? Yeah. So which components are included in the financial account? Do you remember? We said there are three accounts: current account, capital account, and financial account. So it's talking about the financial account just right now. Right now. I just opened the exam and this is the first question that we are on. Right. So which components are included in the financial account of the balance of payment? The balancing item. So if you don't remember, the balancing item was, I said that not always a country has complete information about the transactions. So when there is missing information, the two sides of the balance of payments do not balance. And to include that amount, you add a balancing item. So if you have ever studied accounting, you will better able to understand. So the two sides of the, the double entry mechanism make sure that the two sides, debit and credit sides, are always equal, but sometimes due to missing information that doesn't happen. And to do that, you have to enter the balancing item, right? So it's asking us whether we record that balancing items in the financial account of the balance of payment. That's the first thing. Then do we record foreign direct investment in the financial account? That's the second thing. And the third thing is interest, profit, and dividends. So what do you think is the correct answer? Students, what do you think is the correct answer? Quickly. Ilsa is saying A, Arbab is saying C. I think the answer is A, and let me tell you why, right? Arbab, so 21, 21, 21, 21, 21. Right, just a second. 21 should be A. 21 is A. Have a look at this, right? So Arbab, you said C, which means the balancing item is not included. The other two things are included. Okay, let me tell you. So the balancing item is part of the financial account, right? So it includes three things. Financial account includes three things: direct investment, investment that is directly coming into a country. Then there is portfolio or indirect investment, as we say. If you remember, I said indirect investment is when foreign investors invest in your stock exchanges. That is indirect investment, right? Direct investment would be something like Mercedes opening their production plant in Pakistan, right? So that is direct investment. Or let's say just like Baskin Robbins, I guess, right? So that's a popular ice cream company. They have recently opened in Pakistan. That's direct investment. They are opening their operations in Pakistan. Indirect investment is anything that comes into your assets, financial assets like stock exchange, money market. That is indirect investment, right? So these two things, and then the balancing item. These are the three items that are part of your. These are the three items that are part of your what is that called? Financial account, right? And this thing, where do we record this thing? Interest, profit, and dividends. This is part of the income section. Do you remember? There was an income section in the current account. It is part of that income section in the current account. If any Pakistani is earning any income on a foreign held asset, that would be either in the form of interest, or that would be in the form of profit, or that would be in the form of dividend, right? So that would be recorded in the income section of the current account. What are the other components of current account? Trade in goods, trade in services, income, and current transfers. So that income section includes this thing, not the financial account. Is this simple? Right? So that's what you need to remember. Okay. Now the next thing says, okay, perfect. The next question says, a country maintains its foreign exchange rate against the United States dollars within a narrow but changing band. Within a narrow but a changing band. What is this type of exchange rate? Fixed, floating, managed float, trade weighted. What is this type of exchange rate called? Right. What about you, Bob? What do you think is the correct answer? Right. What do you think is the correct answer? Right. Okay. Trade weighted exchange rate. Are you asking about this option, the fourth option? Trade weighted exchange rate is something very different. So trade weighted exchange rate is not against any particular currency. Okay, the last part. Okay. Think about this. The country maintains its foreign exchange rate against US dollars, right? Within a narrow but changing band, within a narrow. I mean, there's a band. Band means upper limit and lower limit. Do you remember we talked about the upper limit and the lower limit in exchange rate? And we said that that is known as managed exchange rate. Do you remember that? Right? Exactly. So the answer has to be C. So very simply speaking, right? Sorry about that. Okay. So the managed exchange rate is where you set the upper and lower limit of the exchange rate, and you don't let it to go outside those limits, right? So this would be the upper limit. If it goes above that upper limit, you will try to bring it back, and if it goes below the lower limit, you'll try to bring it back, right? That is what it means. So it is managed exchange rate, and here it means managed float. It is floating. Floating means free floating, right? But it is managed. You're not letting it completely free, right? So 20 is C. Great. Next question. Okay. The next question says, the balancing amount is the flow to and from the gold reserves. Is it? Yeah. Just a second. Elsa. So that is, no. That's another thing. That's changes in foreign reserves. That's changes in foreign reserves. Just a second. So there was direct investment, there's indirect investment. Yeah. Then there is balancing item is a separate thing, right? Right. Just a second. There's a term for that, but that is skipping my mind. So that usually direct investment, indirect investment, uh, reserves. That is known as reserves. What you are referring to, I got you. And sorry, I've skipped that while I was explaining that. Right. Net balance for foreign direct investment, portfolio investment, as I said, balance of banking flows, hot money flows, changes in the value of gold reserves. Yeah, change in the value of reserves, gold and foreign currency. So sometimes it's known as reserve, sometimes it's known as, right, but reserve is the word. Reserve is the word for what you are referring to. Bob, sorry, I missed out on one thing. So financial account has not four components, right? So there's foreign direct investment, there is indirect investment, right? Right. Then you have right. Then you have reserves. Let me write that down for you, right? So financial account of a country has basically four items, right? So it has foreign direct investment, which is short form FDI, right? Foreign direct investment. Then you have portfolio investment. As I was telling you, if someone is investing in Pakistan Stock Exchange, right, that would be an inflow, but that would be recorded in portfolio investment, right? Not coming directly into a business like Baskin Robbins or, a company opening a production plant in Pakistan, but that is in a financial assets. Then comes in reserves. So reserves are the changes that happen. So if there is a deficit, Elsa, if there is a deficit, that will decrease your reserves. And if there is a surplus, that will increase your reserves. And then the fourth item is balancing item, right? Right. So that is what I was telling you, that balancing item shows if there is any missing values because of which your balance of payment is not balancing. So that would be the balancing item then, right? Deposits, yeah. Reserve assets, yeah, absolutely correct. Okay, we good on this, students? Just a second. Okay, now let's move to the next question. Right, clear, very good, perfect. Okay, what is likely to cause a decrease in aggregate demand? What causes a decrease in aggregate demand? An appreciation of the exchange rate, okay, an improvement in consumer confidence, an increase in government expenditure, and increase in money supply, right? So that should be, Bob, think about it again. Think about it again. What causes a decrease in aggregate demand? What causes a decrease? Think about this. When there's more money supply, which means that there will be more lending, people will be spending more, right? Did you get this part, Arbab? So if there is more money supply, which means that banks will be lending more money in terms of loans to people and so on, and they will be spending more. So overall, the demand will increase, right? Right. It shouldn't be a thing. What happens when your exchange rate becomes weaker? Think about this. Students, whenever you have a question like this, the easiest way, what I've always done and will help you as well. So just think about what are the components and what each factor that we have over here will have an effect. How will this affect each of these items? Think about this. So X minus M. When your exchange rate appreciates, Arba, when exchange rate appreciates, your exports become less price competitive because your products are becoming expensive for foreign consumers. So your exports will go down. And since your imported goods are becoming cheaper for you, so your imports will go up. And overall, your aggregate demand will decrease. Does it make sense? Arba? Are you getting what I'm trying to say? So when your exchange rate becomes stronger, your products are becoming less price competitive. Why? Because then each dollar will buy less of Pakistani rupees, right? So now Pakistani products will be more expensive for Americans and similarly for other countries, right? So that means that they will buy less from us. So exports are decreasing. And since for us, products on Amazon, American products will be cheaper because our currency is becoming stronger. So our imports will increase. Are you getting me? And since imports is with the negative sign and exports is with the positive sign, exports are going down, imports are going up. So we are not producing much in Pakistan. So overall, your aggregate demand will go down. Does it make sense? Right? So 19 should be A, right? Got it? Right? Because there's no other option. I've just explained you that increase in money supply would mean that there will be more lending and people will be buying more, so overall aggregate demand will increase, not decrease, right? So that can't be the option. C is incorrect because government spending more. Obviously, G is a direct component in aggregate demand. That would mean higher aggregate demand. Improvement in consumer confidence. Again, when consumers are more confident, they spend more, consumption will increase, and so on. So sometimes it's also good to just do the elimination. Sometimes you can get confused in your MCQs. So what you have to do then is to just see which one can I cross out, and then the one that is left should be the answer. Okay, a country's railways are currently run by private firms. Okay, it has been suggested that the government should nationalize the railways. So currently railways run by the private firms in a country, and they are suggesting that the government should take over. What might be the reason for this? To control price of railway services, to encourage competition in railway services, to increase the profit incentive, to provide jobs for local people. Right. What do you think? So what is the major benefit? What will be the major benefit of government taking over a railway firm? That's what the question is asking. Arbab is saying D. Right. Now, obviously, we are choosing between A and D, right? So C is absolutely incorrect. Profit incentive will not increase, that will decrease, and competition will again not increase, that will decrease, right? So B and C are absolutely incorrect. More jobs for people, I think both should be acceptable, right? Yeah, but you have to choose one. Which of the two do you think will make more sense? Elsa, what do you think? So you guys tell me your options, and then I'll tell you what I thought, and then we'll look at the marking scheme. D. Okay, fair enough. Fair enough. Fair enough. Yeah, Ilsa, what do you think? So if I'm not wrong, right. So think about this. Arbab, let me answer this. The first time when I did this question, I selected D, and then I looked at the marking scheme, and that was incorrect. My reasoning of choosing D was that we know that government firms provide more jobs, right? Because their obviously objective is not to maximize profit, and they're aiming for getting more employment rather than rather than profit maximization which the private sector does. right? And why was I did not think of A to be correct? Because the prices can be controlled anyways, right? Government can interfere even in the private sector firms to control prices by setting a maximum or a minimum price. So that was my reasoning in the first time. But then I checked with the marking scheme and that was A, right? And A also makes sense, right? So let me check. I think I did it correctly. 18 is A. 18 is A, right? So the reasoning is that in this way, the government, as Elsa said, this way the government will be more, capable of controlling prices. Prices can be more easily controlled, right? So that could be one logic that you can think about it. So can you see that sometimes MCQ questions are very weird, right? There are two correct answers and you can't really tell, but you just need to try to think, right? Yeah, I agree with you, but can't help it, right? So one reasoning that you can provide for option A is that the government will be able to control prices more directly because now it's the government running that, unlike the private firm, right? Okay, now which measure would not be part of a government subsidy to protect domestic producers from competition? Which measure would not be part of the government subsidy to protect domestic producers from competition? Import quotas, interest-free loans provided by the government, right? Reduction in profit businesses taxes, transfer payments. What would not be part of the government subsidy to protect domestic firms from competition? What do you think? A, because the competition is between domestic firms, not international. Okay. Okay. We're saying A because the competition is because between domestic firms, not international. Okay. Arbab, what do you think is true? I mean, whenever there is, think about this, whenever there is so what the question is saying that you have to protect your firms from international competition, right? Obviously, it's when you import quotas, right? You are protecting from competition can be from anyone. Okay, I got your question. Elsa. So you're saying that competition is between domestic firms, not international. I would say, it can be between anyone, right? And primarily with international. Right. I also think it's D because transfer payments are the payments that you're paying to disadvantaged or less privileged people, right? So that is not directly protecting the businesses. That is just kind of social welfare payments that the government is making. So 17. Whoa. Whoa. Now this doesn't make sense. Which measure would not be part of the government subsidy to protect domestic producers from competition? Transfer payments. Transfer payments. How is transfer payments the answer? Transfer payment is a payment of money for which there are no goods or services exchanged. Transfer payments commonly refer to efforts by local, state, and federal governments to redistribute money to those in need. Yeah, that's what I'm saying. Social security, unemployment, or common types of transfer payments. Welfare, financial aid, social security, government subsidies. Okay, so it does include government subsidies for certain businesses. Okay, so I think, Arbab, did you get this part? Okay. Elsa, so your answer is correct. Uh, even though the reasoning might be different, but yeah, you got it correct, right? So the reason what they have given over here is that transfer payments, I was just thinking that transfer payments doesn't include subsidies, but sometimes transfer payments can also include subsidies like to smaller businesses to support those smaller businesses, right? Is it making sense? Is it making sense? Uh, right. So the reason is, okay, think about this. So import quota is also stopping competition, but that's not a form of subsidy, right? So subsidy is a recurring payment. Subsidy is a recurring financial payment that governments provide to businesses, right? Do you understand recurring? Like that happens over time, periodically, right? Um, yeah, import quota is just one of thing that is just stopping imported goods. That is also protecting competition. That is also stopping competition, but that is not at least a subsidy. That is not in the form of financial payment to the local firms. That's what the question said, right? Because in trust-free loans, think about this. It's a financial payment that the government is giving. With loans, the businesses can expand, can invest, and so on. Similarly, reduction in profit taxes. So if taxes are reduced, then again, businesses will have more money to invest. And transfer payments also include subsidies that the government is giving to some type of businesses. So that is again money available to invest. But import quota is not a money. That is just protecting you from competition, but it's not money, right? Okay. Now, moving to the next question. A government decides to replace a private company with its own company to collect household waste. What, why could such action be justified? Because waste collection is a public good. Cost of waste collection are bound to be lower if paid out of local taxes. Private companies are always less efficient than government companies. Private companies might put profits before customer needs. Private companies might put profits before customer needs. Hmm. Right. Like the question, you did not get the question, or you did not get the one of the options. Like the question, okay. The question is saying the government decides to replace a private company. So think about this. There was a private company that was previously collecting trash, right? And then now it has been given to a government has taken responsibility of that. Waste production, waste collection like the trash, trash collection company that collects trash is a public good. What is a public good? Public good is non-excludable, non-rivalry, right? So think of defense. You can't exclude anyone from benefiting from it, and everyone gets the same benefit, and everyone gets the same benefits, right? So that is what public good means. Cost of waste collection are bound to be lower if paid out of local taxes. So they're saying that if the cost of trash collection is paid by taxes, like the taxes that we pay, right? The taxes that we pay to the government, then the cost would be less. If a private firm is collecting trash, the cost will be higher. If a public company is collecting trash, the cost will be lower. That is what it basically means. Option B. Then option C says that private companies are inefficient, are less efficient. They don't work very as much efficiently as much the government does. That's what it says. And the D says that private companies put profits. They prioritize profit collection more than the customer needs. So what is the reason? Why could this action be justified? So it's saying that what is the reason of government collecting the trash rather than a private company? That is what it asks in simple words. Why would government want to replace a private company? That is what the question is asking. So what do you think? Right. Yeah, that should be D. Absolutely. 16 is D. Very good. Perfect. Let's move on. Okay, so the next question says the diagram shows the demand and supply curves for rice. What would happen if the government imposed a maximum price of 10? So maximum price is 10. The equilibrium price is 8. The maximum price is 10. So it says that what happens if the government imposes a maximum price of 10? The government would need to supply Q1, Q3. The quantity sold would be Q1. The quantity sold would be Q2. And the quantity sold would increase from Q2 to Q3. Right, absolutely. Excellent. See, the quantity sold is in effect. Sorry, the quantity would stay at Q2 because the maximum price can never be above the equilibrium. The maximum price can never be above the equilibrium. It's ineffective. Excellent. Okay, next question. Okay. The question says that privatization can be achieved by the sale of shares to the general public, which is called public offers, PO, or by direct sale to a private company, private sale, PS. The diagram shows the privatization transaction and the revenue for European Union between 1981 to 2012. So now there are two axes to the graph. On the left axis, you have revenue in European millions of euros. And on the right axis, you have the number of transactions, right? And then the light gray area, as you can see here, is the revenue from public offers, PS, and sorry. The revenue from PS is the private sale, PS, right? And the revenue from PO, public offer, is the dark gray area. And this line, this dotted line that you can see over here, this is your basically transactions. Now, let's read at this options. What can be concluded from the diagram? Any increase in the number of privatizations resulted in an increase in privatization revenue. So it says that whenever there was increase in the number of transactions, there was also an increase in revenue. Okay. The B says that the average revenue per privatization was highest in 2000. So in 2000, right, the average revenue, right? What would be the average revenue? Total revenue divided by transaction. The average revenue was highest in 2000. Okay. The C says that the main revenue from privatization changed from public offers to private sales. From public offers to private sales. Right. Is this correct, Elsa? So for C, the main revenue from privatization, yes, right? Because from, think about this, where are public offers? So public offers were darker gray. So if you look at the earlier years bars, if you look at the earlier years bar, these were all dark gray. These were all dark gray. But all of a sudden, after this, what happened? The lighter gray area started to increase and the darker gray area started to decrease. This means that public offers decreased and the private sales increased, right? So that would be, but A makes sense too. No, it doesn't. Let me tell you why. So revenue is highest. Think about this. Revenue is highest in which year? Transaction is highest in which year? In this year, 1994, 1995. Elsa, are you following me? So this dotted line is showing you the transactions. So I'm saying that the transaction was highest in 1994, 1995. But if you look at the revenue, revenue was quite low. Revenue was quite low. Yes or no? Revenue was quite low. Whereas on the other hand, revenue was highest somewhere in 2000. Revenue was highest in 2000, but the transactions were relatively low. So you can't say that the increase in privatization resulted in increase in privatization revenue. The two things are not going hand in hand, right? Did you get my point or did you not? 14 is C, right? Okay, perfect. Let's move to the next question. Okay, the next question says, in the market for a good, the quantity supplied and the quantity demanded are given by QS this and QD this, where P is the price in dollars. A change in text on the good makes QS P minus 36. How will the change affect equilibrium price? How will the change affect equilibrium price? Yeah. So any idea what you're supposed to do in this question? Right. So think about this. What you have to do, right. Absolutely. So simply speaking, what you are supposed to do is that what happens when, let me draw it over here, right? So when a tax is imposed on a good, there is a change in its market equilibrium. How does the market equilibrium change, right? So let's say this was your original demand supply. Sorry about the not so neat diagram, just a second, right? So this is your demand supply diagram, right? Downward sloping was your supply, demand, upward sloping was your supply. So originally where the demand and supply were intersecting, that was your equilibrium price. Then the government imposed an indirect tax, and we know whenever there is an indirect tax imposed on a product, your supply curve shifts leftwards. So supply curve will shift leftward. The new equilibrium would be where the new supply and the demand curve are intersecting. So that then it would become P2. The price will rise to P2. Is it making sense? right? So that is what you're supposed to do. First, you will equate the original supply and original demand, find out the price, and then you equate the demand with the new supply and see what the price is, right? And you will see that the answer will turn out to be C. It will rise by 2. It will rise by $2, right? In the first scenario where you're equating the original supply with the original demand, it will be, I think, 90. I think I've done this question before. Equilibrium price will turn out to be $90. Then later, when you will equate the demand with the new supply, your equilibrium price will turn out to be $92. And that shows that there has been an increase of $2, right? Okay. Okay. Now that's the next question. The diagram shows the supply curve of a product. The government imposes a specific indirect tax of $5 on the product. How will the price elasticity of supply of the product change? Right? So this is the supply curve of a product. And then it says that the government has imposed a specific tax. What is the specific tax? Specific tax is that the amount of tax is fixed per unit. Specific tax is that the amount of tax is fixed per unit, right? So it will go like this, a parallel shift upwards. It will be a parallel shift upwards like this, right? So what will be the price elasticity supply of the product? What will be the price elasticity of supply of the product? B, from inelastic to elastic. From inelastic to elastic. Right. What do you think, Arbab? Okay, now let me tell you in advance, I have done this question before and I was surprised to see the answer. So you'll be a little disappointed to know that the answer to this question is, which I don't agree with. And to be honest, I did not make much sense of it when I was doing it back. So the answer for that, I think, is 12 is D, from unitary to elastic. Let me check. So what question was that? 12? Let's see what the answer is. 12 is D. Can you see? That's what I said. You will be disappointed, right? So from unitary to elastic. So the only explanation I could think about it, since the graph is starting from the, no, that's perfectly elastic. So you're talking about this. So that's perfectly elastic, the horizontal. The horizontal line is perfectly elastic. The vertical line is perfectly inelastic. This is perfectly inelastic, the vertical line. And this horizontal line is perfectly elastic. Right? So the only explanation that I could think of was that unitary, if it's starting from the origin, it's unitary elastic, which means that the value is equals to supply, right? So the value would be equal to +1, right? And since there is only one option, there's only one option that says from unitary to something else. So the answer would be D. That's the only, no quantity marked on D. There's no quantity marked on. It says 1 now, from unitary, like equals to 1, right? So that was the explanation that I could think of, but I don't think so it makes sense because the supply curve, as you can see, is already very steep. As you can see, the supply curve is already quite steep, right? So if that's less steep, that's more elastic, right? If, you know, it's steep like this, like the one over here, it should be less elastic. But I mean, yeah. Right? So sometimes there are also weird questions like these. Okay, what is the major function of the price mechanism? Providing incentives for the government intervention to reduce income inequality, removing shortages by creating incentives for the market price to fall. Right. Removing surpluses by creating incentive for market price to rise, signaling changes to market conditions to producers and consumers. So what is, it says, what is a major function of the price mechanism? So out of these options, which one do you think is correct? D, right, Arbab? D, right? Because obviously the other options are incorrect. The other options are incorrect, right? And D also makes sense, right? Okay, great. Now the next question says, a good has a price elasticity. Good has a price elasticity of supply of 2. The current quantity supplied is 30 units per week at a price of 20 per unit. The firm raised the price to 25 rupees per unit. What is the new quantity supplied per week? What is the new quantity supplied per week? What is the new quantity supplied per week? So do you know how to calculate this, or do you want me to show it on a board? So all you have to do is think about this. All you have to do, right? We'll use the right, exactly. Yes, we will, right? So what is the formula of price elasticity of supply? Price elasticity of supply is simply speaking percentage change in quantity supplied divided by percentage change in price, right? Now we don't know what the percentage change in supply is, and that is what it's asking us technically, right? But we do know this value and we do know this value. So this means that out of 3 values, if we know 2 values, we can calculate the third one. Now, price is changing from $20 to $25. The price has changed from $20 to $25. So how do you calculate the percentage change in price? So this is the new one and this is the old one. So how do you calculate the percentage change? New minus old divided by old. New minus old divided by old into 100, right? So that will give you 5 over 20 is 25%. So how much is the change in price? So there's a 25% change in price. Students, are you following me or not? So the change in price is 25%, right? What is the change in supply? We don't really know. That is what the question asking. And what is the price elasticity of supply? That is 2. Now you cross multiply this. So 25 twos are 50%. So X is 50%. This means that the change in supply would be 50%. So if price is increasing, obviously, if price is increasing, the supply will also increase. Yes or no? Because the two variables are in direct relation, right? So if price is increasing by 25% and the price elastic supply is 2, obviously the supply will increase by 50%. Now, what is 50% higher of this? What is 50% higher of this? Because it's saying what is the new quantity supplied. So what you have to do is you have to calculate the 50% higher of this. So you will say 300 into 150. So you cancel this out, and 15 times 30 gives you 450. So the new quantity supplied would be D. Did you guys get this? So you just need to calculate 50% higher of this. So either you can calculate it like this. So what is 50% of 300? 150. And then you add 150 to 300. Then you add, because that is increase, right? Easy, simple, right? So let's see, 10 should be D. 10 is D, right? Okay. So this is the next question. So students, how about we stop here for today? And tomorrow we won't have the class, but we will have it on tomorrow is Thursday, right? We will have our class on Friday. Right. So I would ask you to go over that. I will ask you to go over this paper, remaining questions, and if you find anything confusing, yeah, go on.
Sir, could you assign a paper and then we'll do it at home, and
Right.
then we can discuss the queries in the online class. So we'll
Okay.
save time.
Okay, that's a very good suggestion. Right. Perfect. So how about we do it like this? So choose, we were doing 2020, right? How about we go in the reverse order? You do May, June 19, right? For the next class, May, June 19, and then we'll go in May, June 18, and then we can also do October, November, but for tomorrow we can do May, June 19. What do you say?